exposing the shocking truth behind the recent stock market crash. Hold on to your hats, folks, because the stock market just took a nosedive. Major indices ended the day significantly lower. Investors are understandably nervous, and for good reason. This wasn't just a minor blip, it was a full-blown sell-off. So, what on earth is going on? Disappointing economic news out of China, rising oil prices, and potential Federal Reserve interest rate hikes have created a perfect storm of uncertainty. Now, before you panic and start selling everything, take a deep breath. The market goes up and the market goes down. What's important is to stay calm, review your portfolio, and make sure you're comfortable with your investments. Many investors are wondering if this is just a temporary dip or the start of something bigger and scarier. A recession. Stay tuned for crucial insights on the potential recession and what it means for your investments. Let's dive into the details and try to make sense of it all.
The jobs report for July was supposed to be a slam dunk. Economists were predicting strong job growth, a sure sign that the economy was firing on all cylinders. But instead, we got a big, fat disappointment. The Labour Department reported that the economy added far fewer jobs than expected, and the unemployment rate ticked up slightly. This news sent shockwaves through Wall Street. Investors had been counting on a strong jobs report to justify the stock market's lofty valuations. The disappointing jobs report added fuel to the fire that was already burning in the stock market. It confirmed investors' fears that the economy might be losing steam, and it sent stocks tumbling even further.
When the stock market gets shaky, investors tend to flock to what they perceive as safe haven assets. These are investments that are considered less risky and more likely to hold their value during times of economic uncertainty. One of the most popular safe havens is U.S. Treasury bonds. When investors get nervous, they buy up Treasury bonds, driving up their price and sending their yields down. That's exactly what we've been seeing lately. As the stock market has sold off, Treasury yields have plummeted. This is a classic sign of fear and uncertainty in the market. Lower bond yields mean lower borrowing costs for businesses and consumers, which can stimulate economic activity. But it can also be a sign that investors are worried about the future and are unwilling to take risks.
Tech stocks, the darlings of the market for the past few years, have been hit particularly hard in the recent sell-off. Giants like Apple, Amazon, and Microsoft have all seen their share prices take a beating, and the Nasdaq, a tech-heavy index, has entered correction territory. Rising interest rates make it more expensive for tech companies to borrow money to fund their growth, which can hurt their bottom line. There are concerns about increased regulation of the tech industry, which could stifle innovation and profitability. Apple has seen its share price decline due to concerns about slowing iPhone sales and increased competition in the smartphone market. Amazon is facing headwinds from rising shipping costs, labor shortages, and increased scrutiny from regulators. Netflix has reported disappointing subscriber growth, raising concerns about its ability to continue its rapid expansion. The tech sector's woes are a reminder that even the market's strongest performers are not immune to pullbacks.
The Nasdaq, a stock market index that is heavily weighted towards technology companies, has officially entered correction territory. This means that it has fallen by 10% or more from its recent high. Corrections can be scary, but they're actually a normal part of the market cycle. Think of it like this. The stock market is like a car climbing a hill. It can't go straight up forever. Eventually, it needs to take a breather, maybe even downshift a gear or two. Now, some corrections are just that, healthy pullbacks in an otherwise strong market. But others can be a sign of something more serious, a harbinger of a bear market or even a recession. Shallow, short-lived corrections are usually nothing to worry about. But deeper, more prolonged corrections can be a sign that investors are losing confidence in the market.
So what do the experts think? Is this recent market turmoil just a correction, or are we headed for a recession? The truth is, there's no consensus. Economists and market analysts are divided, with some predicting a soft landing for the economy and others warning of a more severe downturn. Those in the soft landing camp point to the fact that the economy is still growing, albeit at a slower pace. They argue that the Federal Reserve can engineer a gradual slowdown in inflation without triggering a recession.
On the other hand, those in the recession camp are more concerned about the risks facing the economy. They point to persistently high inflation, rising interest rates, and the ongoing war in Ukraine as major headwinds. Ultimately, time will tell whether this is just a market correction or a prelude to something more serious. In the meantime, investors should stay informed, review their portfolios, and be prepared for continued volatility. If you found this video helpful, don't forget to like, share, and subscribe for more updates.